So the way it looks like, it doesn't look like you have a situation where you can have India doing badly and the rest of the markets doing very well from here.
Indian markets by themselves, especially the large cap space, is getting more sensible. It's delivering possibly earning-led returns. And we think earnings should improve, allowing for much better outlook for larger, at least Indian equities. Was mentioned on terms of IPOs and all. Clearly, there is a lot of euphoria shifted from public markets to private markets and or IPO markets, and we are finding their valuations higher than listed companies already. So it's like relatively something is better priced, but on an absolute basis, can you make large returns? I don't think that is the case anywhere. So expectations have to still tend very moderate earning-led.
Foreign investors come to India, FIIs is for the growth, right? Relative growth in India is better, and they are willing to pay a premium for that. Now that really faltered last year. If you look at last 4 quarters, the earnings growth for corporate India has been in the mid-single digit, which was kind of prior to that growing at somewhere in the high teens, right, for almost 2.5 years. So clearly the fact that the growth slowed down, so that was one of the reasons why the markets underperformed.
At the valuation of the Indian company, you are getting the global business for free. So clearly, all excesses have not gone away. Headline multiples, you can look at 22 times earnings, 23 times earnings, whatever is your favorite number one can pick. Doesn't seem too excessive. But there are pockets which are clearly exuberant where excesses still have to be worked out.
I think there is some more elbow room for the RBI to ease policy, but we need to be realistic to the extent of additional rate cuts that you may get in this cycle. So where we stand today, it's clear that there is space for them to ease, but we need to recognize that a large part of policy easing is already behind us. And I think there's a lot of comfort in the fact that we are not staring at a reversal of the cycle anytime soon. So my sense is that we possibly see one more rate cut from the RBI and a long period of pause alongside favorable liquidity conditions. So I think that's a very significant, sufficient impulse to revival of economic growth.
Yeah.
Thank you, Baswar. Good afternoon and warm welcome to all the panelists and those in the audience. Over the last 1 year, India's equity markets have been through a phase of relative underperformance after several years of strong gains. This shift has naturally influenced investor sentiment and has called for both caution and introspection. Today, we explore how the investment leaders are interpreting this phase and what it means for valuation, risk appetite, and long-term investing mindset in India. So I'll start with Naren. Sir, you have been cautioning investors last year when markets were at their peak, and now we have seen some 13-14-month period of consolidation or stark underperformance to global peers. Do you think now is the reason to cheer, or one should still be more guarded?
I think India has now meaningfully underperformed all the markets in the world, actually. And, earlier we used to think India was overvalued and all other markets were undervalued. Now, when you look at it, all markets look overvalued, actually. And so the way it looks like, it doesn't look like you have a situation where you can have India doing badly and the rest of the markets doing very well from here. So our view at this point of time is if US market continues to do well, India also has to do well. It can't be like last year where US did well and India did badly. However, at some point of time, I think global markets also should see a correction, because when you look at valuations, particularly of US artificial intelligence-based stocks, you can clearly see that they are all very, very costly. And today, many companies are worth $1 trillion. One stock is worth $5 trillion. Another is worth $4 trillion. And therefore, I think at some point of time, there should be a US AI stock-based correction. But till that point of time, India should also do well from here. So our thought process last year was maybe more caution dependent on India. Now we tell people do asset allocation, but maybe a bit more positive than last year. But we no longer worry specifically on India because I think India has very good macro, much better situation in terms of long-term growth story. People have realized that you can't make money too easily in secondary markets. So that level of extreme buoyancy in secondary market doesn't exist except in the IPO market. So I believe that we are in a better shape for, but at the same time when we tell people you can't make mega returns from here, people don't tend to believe us. So we are in a moderate return situation, but safer than 1 year back.
Thank you. A lot of investors come to the market with expectations of huge returns. And we have seen, those who have, such investors have been left disappointed. Sailesh, do you think this reset that we have seen over the last 13, 14 months was required? And now will it help recalibrate expectations?
See, expectations are not getting recalibrated because when we meet people, we realize return expectations haven't shifted down because they are making money somewhere else. Gold is giving them silver. Something or the other is moving. And every Indian, I'm sure, is feeling left out seeing US markets. Right? So I think the excess money, or you call it, or the euphoric expectations are shifting from market to market. Indian markets by themselves, especially the large cap space, is getting more sensible. It's delivering possibly earning-led returns. And we think earnings should improve, allowing for much better outlook for larger, at least Indian equities. Was mentioned on terms of IPOs and all. Clearly, there is a lot of euphoria shifted from public markets to private markets and or IPO markets, and we are finding their valuations higher than listed companies already. So it's like relatively something is better priced, but on an absolute basis, can you make large returns? I don't think that is the case anywhere. So expectations have to still tend very moderate earning-led.
Since we peg India's performance to other global peers, this year India has been a stark underperformer. Like the MSCI emerging market is up some 25-30% led by China, South Korea, and we are largely flat in dollar terms. Mahesh, what do you think has led to this underperformance, and does India look better compared to peers now?
Yeah, so if you look at a year back, right, India market was doing well. Right, valuations were high at that point in time if you compare with the other market. In fact, India's relative valuations with the other emerging markets had reached a kind of a peak level, what we had seen last 10 years. This is around 1.5 years back. But more importantly, I think why foreign investors come to India, FIs, is for the growth, right? Relative growth in India is better, and they are willing to pay a premium for that. Now, that really faltered last year. If you look at last 4 quarters, the earnings growth for corporate India has been in the mid-single digit, which was kind of prior to that growing at somewhere in the high teens, right, for almost 2.5 years. So clearly, the fact that the growth slowed down, so that was one of the reasons why the markets underperformed. Also, in the initial part, we had seen some kind of a fiscal contraction which was there, right? Government spending was low because elections. Monetary policy in the initial period was slightly restrictive, right? At a time when we have seen a growth slowing down. And all that factors actually led to the underperformance, I would say. And then more recently, somewhere in the mid of this calendar year, the trade policy, right, which was also impacted, and the uncertainty on the trade deal led to the underperformance. And also, somewhere down the line, we saw rupee itself, right, rupee, which was one of the strongest currency, right, prior to that. If you look at a year back or prior to that, Indian currency in terms of volatility, performance was really strong. So that also came under pressure. I think all these factors led to the underperformance. And I think a lot of these things are now reversing, at least are not negative at the margin now, right? Whether you're looking at in terms of growth itself, I think now with the stimulus which has been given in the budget, the GST rate cut, consumption, which was one of the pillars of the GDP, which was weak, which was lagging. Since COVID, I think that has been lagging. That is, I expect to get some kind of a boost from here. So you should see monetary policy is now pretty easy. I think RBI has a lot of steps, okay, to ease liquidity. Even for the banking system, I think a lot of things have given so that we can go out and lend. We have seen rate cuts, 100 basis point, probably more you could see down. So that should start, as the impact of that translate, you should see now growth at least improving. And one should expect that in the next few quarters or next year, at least the growth should be in the double digit, at least for the earnings growth. And I think all that, I think, should, as I said earlier, I think the outlook at least looks better than what it was a year back. Valuations also of the market, this thing, are now more reasonable, I would say, both relative as well as in absolute terms. So, yeah, I think, and most important thing is the trade deal, right, which was the last kind of salvo which hurt our market sentiments. I think we are also now progressing over there, seems to be in the right direction. So once that happens, I think the sentiment will improve, and most importantly, for a sustainable recovery from here, require the capex to come in, the private sector capex, and that will come only when there is more clarity on the trade deal.
Thank you. Rajeev, valuations are now more reasonable. Growth should pick up. Do you also share the same views? I'll go to Rajeev Thakkar first, and then I'll come to you.
Things are better than last year, surely. 12 to 15 months have gone by without stock price moving up. Earning growth, although has been anemic, still earnings are higher than what they were last year. However, on a relative basis, if you look at some of the newer listings, especially MNC companies, now the Indian company earns a fraction of the global revenue, whereas the Indian market cap is equal to the global market cap. Clearly, there is some disconnect. One can argue India is a growth market, all of that. But if you buy the parent at the valuation of the Indian company, you are getting the global business for free. So clearly, all excesses have not gone away. Headline multiples, you can look at 22 times earnings, 23 times earnings, whatever is your favorite number one can pick. Doesn't seem too excessive. But there are pockets which are clearly exuberant where excesses still have to be worked out. And growth, increasingly, I think the country of listing does not matter so much. What matters is the underlying business. So let's take tech, for example. Our companies are mainly services companies which have shown flattish kind of revenue growth. Whereas you look at the Mag 7 reports coming in. Now, these companies are growing 15, 20% in dollar terms and growing bottom line at 30%, even on such a large base. Whereas our large companies are not showing that growth. So unless growth comes back and we have valuation parameters which are comparable, you won't see explosive returns from here on. Still, I would think from a 5-year perspective, equities will deliver better than bond kind of returns. So people should stick to their asset allocations, but don't expect hyper-normal kind of returns. That's the message I would like to convey.
Thank you. Valuations have cooled off, but there are pockets of exuberance, so one has to be careful. Now let's get some views from the debt side. Amidst the sort of turbulence in the equity space, how has the debt space looked like? Have returns been better than normal? I mean, how are things played out there?
In fact, unlike equities where we always debate about the valuations in the market, I think on the debt space where we are today, and at least on a forward-looking basis, the valuations, if we were to look at, they are very favorable, because after a long period in time, you have a phase where you're not really worried on inflation. I think that's a big narrative change that has clearly happened, right? And of course, we've seen the RBI being accommodative to the extent of policy rate actions, more so on the beyond the headline policy rates. There's been significant amount of liquidity infusion measures that they have done. So standing today on a forward basis where inflation is expected to be, I think this financial year, we're looking at an average of something like 2.6. And even on a forward basis, you are anchored close to the inflation target of around 4. That clearly is a very favorable backdrop from a debt market perspective. I think there is some more elbow room for the RBI to ease policy, but we need to be realistic to the extent of additional rate cuts that you may get in this cycle. So where we stand today, it's clear that there is space for them to ease, but we need to recognize that a large part of policy easing is already behind us. And I think there's a lot of comfort in the fact that we are not staring at a reversal of the cycle anytime soon. So my sense is that we possibly see one more rate cut from the RBI and a long period of pause alongside favorable liquidity conditions. So I think that's a very significant, sufficient impulse to revival of economic growth.
Yeah. So you said conditions are favorable for fixed income, but where do the opportunities lie?
So I think that's a very interesting question. So even in a very, even when you look backwards over the last 1 year, most of the short-end fixed income funds have done very well in terms of, returns. But have you really seen flows there? No, not really, right? I think the bigger challenge clearly is that the way our taxation is something that we keep, I think that has come in so many discussions that we've had in the past. And the reality is that, yes, that is impacting allocation into fixed income products. But on an encouraging sign, we have really seen a lot of flows coming into fixed income through hybrid and asset allocation type of products. So I think going forward, these are the type of products where one would possibly see the fixed income play or the fixed income allocation being made. It's very challenging, honestly, given the existing tax regime, even in a very favorable backdrop of policy rate easing, to anticipate flows coming into these products. So I think that's a big challenge that we clearly have.
Right. Most of you all touched upon the IPOs. This last year, we had a record run, I think 1.6 trillion, which is close to $20 billion US dollars got raised via IPOs. This year, we are set to surpass that tally. This momentum is also underpinned by participation of domestic mutual funds. So if I have to ask you, there is one narrative that the kind of flows that are coming into the mutual fund schemes, we need this kind of paper supply to ensure that the secondary markets don't heat up too much. Do you also share this view, and how do you approach when it comes to investing in IPOs or block deals?
See, we have to be choosy, right? Our job is to select, allocate capital appropriately. And in any bull market, there will be supply, because bull market by design creates an opportunity to sell. So today, anybody who wants to sell his stock, whether it is a promoter, whether it is a private equity investor, because these kind of markets with such good valuations are not available in the dreams of a lot of the people who have invested in earlier. So I think that is the nature of the market. For us, it's very simple. Are we buying the right business? Are we paying the right price? I think when you don't get these two things ticked, we are generally careful. And like you said, IPOs or the new companies are generally, especially new age, new category businesses which are being formed and which have a right to win. Those businesses, we would welcome them in the markets, right? So any business which will allow us to buy a sensible long-term opportunity, we are okay.
Sure. Mr. Naren, right price, right business is the same approach or same mantra that you follow. How do you go about looking at IPOs?
The thing is that we have today a lot of money, so that money has to be deployed. So as you pointed out, if IPOs and blocks and QIPs had not come, I think it would have been a problem. Markets would have rallied a lot. So I think from that point of view, it's good. The challenge for us is that we should allocate, but if I go back, and I said this in another meeting, that if I go back to the 2006 to 2005 to 7 capital cycle, the principal allocator of money was banks in that cycle. So all the decision on who funded capex happened through banks. And when things went bad, it was the banks which were sitting on non-performing loans. In this cycle, the entire burden of capital allocation is happening through direct equity investors, mutual funds, PMSs, AIFs, etc. So if the capital allocation happens wrongly, the investor is going to get directly affected. Unlike the last time, where actually banks made the mistake and then there were non-performing loans at that point of time. I don't know whether investors recognize that they are taking all the risks in this cycle. And we are all agents. So whether it is a mutual fund or anyone else is an agent in this cycle. So the entire burden of risk transfer is now transferred to investors. And while we are agents and we have to do the job, it becomes, therefore, the responsibility becomes tougher on us. And investors don't recognize, they're so fond of equity today because the cycle has been now in the 13th year that they think equity is riskless. Then they think micro-cap equity is even more riskless. So what happens is you've created a condition whereby they are willing to take risk, and that risk ensures that almost anyone and everyone gets funded through these IPOs. So this is a risk finally the investor will bear. Like at some point of time when the wrong company raises money, the investor will bear. And if investor invests in a small cap fund, the investor is investing in small cap fund. So then the small cap fund has to invest in small cap stocks. So if the small cap companies raise money stupidly, the small cap investor will lose. So this is something people haven't understood in this cycle. So effectively, it is the investor who's taking all the risk. In the last cycle, banks took all the risk. In the early 90s, when I started my career, the risk used to be taken by the development financial institutions at that point of time. So over different cycles, different people are taking the risk. And this is something I hope investors recognize, and they recognize that they are taking all the risk in this cycle.
This is a very important message. When we invest in a mutual fund scheme, we are essentially asking the fund manager to invest your money in a particular cohort of the market. I mean, fund managers, of course, will use their discretion, but you're not giving them money to sit on that or sit on cash. Mr. Patil, I would like to ask you, despite the volatility, flows have not seen any sort of de-acceleration. So does it make the job of fund managers challenging? There is so much money that is coming in, but valuations are not where they should be. So how does, as a fund manager, how do you tackle this?
Yeah, so it can be a challenge, okay, in certain categories, right? Because if the flow come in a particular categories, like for example, say mid cap or small cap, right, where the the free float is limited, and also the new supply coming in also is limited, then clearly I think there is a challenge in terms of deploying that. And again, earlier we also had some option of investing into overseas market, right? Because and some of the funds have done that in the past. So that option is also no longer there. So you have to be restricted to the Indian market, and that at times can be challenging. We saw that actually it was acute a year back or 2 years back, right, where we saw big money come into the small cap and the mid cap schemes, and that created that kind of a bubble. And we've seen some kind of a moderation of that happening through. As a fund manager, clearly I think in that scenario, it either comes to how to manage that, right? So you would see a lot of funds, the number of stocks in the portfolio has gone up quite a bit, right? Especially very large schemes where the money flow has been large. Then you need to necessarily diversify more than what you would normally like to have in a portfolio, right? So that's one way to mitigate and disperse that flow into liquidity into a large number of stocks. But I think the flows have now kind of moderate, and in fact now the supply is more. In fact, in the last couple of quarters, we've seen again, as you rightly said, the supply is not only coming from IPOs, but it is also coming in from QIPs, promoter sellings, a lot of MNC companies, global, they have also used these high valuations to really liquidate. So I think there is enough supply now which is coming. In fact, I'm slightly worried now in the supply which is lined up, right, in 1 or 2 quarters. Yeah. And the flows, I think there is a right balance. And in fact, especially in the large and the mid cap, there are large ticket IPOs which are coming in. So to that extent, I think that is also going to be a reason why the market growth also now will be slightly more sluggish, because you will see a good amount of supply hitting the market.
So one way to tackle the problem is having more stocks in your portfolio. Mr. Thakkar, I would like to pose the same question to you. I mean, there's so much liquidity that is coming in, and valuations are not as attractive as they should be. How do you sort of approach the market?
Sure. So thankfully, one advantage that we have is we don't run too many sectoral or thematic schemes, or we don't run market cap based schemes. We run only diversified funds. So that helps us to go where we see opportunities. In every frenzied market, in the current one or even in the past, there are pockets of excesses and there are pockets where people have lost interest or people ignore those spaces. So in late 90s, there was a bubble in TMT stocks and what was called old economy was ignored. Ironically, 2007 bubble was in real estate, infra and commodity, whereas you could actually buy IT services or FMCG kind of names in 2007 and still do reasonably okay. So what we do is one, focus on areas where the valuations are not excessive or where past returns have been moderate, where no optimism is priced in, people are generally pessimistic. That is one thing that we do. Secondly, if we don't find something compelling, we don't force ourselves to be fully invested at all times. So different fund houses have different thoughts on this, but at our end, we say that we will deploy when we really are excited to deploy.
Mr. Naren and Mr. Bhan, would you also like to share your strategy as to how does one tackle this problem where there is so much money coming in and opportunities are few?
In the last 2 years, almost continuously, we've been marketing only asset allocation strategies and telling people to focus their entire investment, new investment on products which are asset allocation oriented, which are hybrid products. Because those are products which are not fully invested in equity because of the currently the investors' belief that only equities are the only asset class. So frankly, luckily investors have responded well and focused on investing with us in asset allocation products and hybrid products. Because we feel that that's the only way to ensure that at some point of time when the market's correct, they would have had a better investor experience, and that is the only way. And other products, we have closed our small cap and mid cap for subscription for quite some time, and it's not an easy decision for us actually, because both investors and everybody have been trying their best, telling us to open it. And the other products we recommend substantially on systematic investment plans. We do have thematic products, but in those thematic products, many of the new, we try to run it with as defensively as possible at some points of time within the requirements of the SID as per SEBI. So, you try to do all these things. These are not capital protection strategies or something like that. But these are the methods that we have tried to do. But, none of us can predict markets. We keep telling people investing is not arithmetic. If people had asked, even 1 year back, we thought some of the US market was overvalued along with India. But if you were a US fund manager, you went totally wrong. US markets continue to zoom. Only Indian markets corrected. So frankly, we all think that we can predict markets correctly, but we can't predict them correctly. And so that's why I think we shouldn't assume that we'll get the market call correct. So that's why you have to do it somewhere in between and focus on hybrid and things like that, where you have a little bit more leeway and have more unconstrained products like multi-asset and all that, so that you try to give investors a better experience and hope you get it right. That's what is the process that we have tried to follow.
Thank you, sir. Would you like to add to that?
See, there are many ways to do it, like, asset allocation being a prime way. As a fund manager, you have to deal with all kinds of market and nobody can predict what's going to happen. So in that, there are times where you have to choose the risk you take, right? For example, this is possibly last year was the time to buy possibly the best quality businesses, even if they were expensive, right? And not possibly put large amounts of money in fragile businesses or micro caps or blah, blah. Our idea is very simple. We take only or attempt to get only as much as we can deploy. For example, in small cap, 2 years back, we have stopped taking money lump sum and we are taking SIPs. And the idea is very simple. We have enough research and support to back select pockets of the market with their opportunities. And second, we have clear communication. The controllable is what? We can communicate what we are doing and we can communicate the risk in the market which is there. So our communication has been less than 5-year money, don't come to small cap, come to small cap only in an SIP structure. You have 3-year, 5-year money, choose large caps over small caps as a category, and that's been the way it is. So, and please understand, if I like the market or don't like the market at a particular point of time, my communication, one, getting it right and wrong every time is not easy. And second, reaching out to, we serve about 20 million investors, boss. So it's not easy to keep changing your strategy based on what you think in the next 6, 12 months. And a lot of the people are coming for 5 years, 10 years, 15 years, right? So the idea is to make sure that you tell them, boss, if you want to put money for 5, 7 years, only that portion of the money you put into this and put it in a SIP format, which I think has worked well. And then choose asset allocation also as a tool to manage it.
Sure. So it's very important that you understand the product that you're getting into and not essentially look for short-term gains. As Mr. Naren said, equities is not the only asset class. Sir, I would like to ask you, you said money has not been coming into debt schemes. So what are the key enablers that would drive flows into this segment? Because at one point, the debt AUM was much more than equity. Now I think if you look at the mix, it has changed in favor of equity. So what would it take to get back investors on the fixed income side?
No, I think clearly the amendments in taxation have played its part, right? I mean, when you look back prior to this, you had a phase when very simple, easy to understand debt products were gaining a lot of traction. I mean, and these are the target maturity products. And there was a reasonable amount of money that had moved into those products. I'm just talking about the few years just before the tax amendment came, I mean, 20 to maybe 23. Clearly, after that, and I think it's a reality that the flow of money into most debt products, especially from retail and the non-corporate investors, that is clearly tapered off. So I think very clearly at some point in time, that possibly needs to be revisited. You could possibly have a slightly longer term, I would say, lock-in. Earlier we used to have a 3-year lock-in to qualify for a indexation or a much favorable tax benefit. Today you have equated a risk-free, I would say, known return product, which is like an FD, which is basically the asset class that people typically are comparing a fixed income fund with, and you're equating that with a capital market product where the investor is taking very active interest rate and credit risk. So I think at some point that distinction needs to be made between a capital market instrument underlying product and something where there is a deposit guarantee or there is an assurance of return. So, I mean, that's completely the domain of fiscal policy. So possibly if that were to be relooked, I think that will possibly bring back interest. The second is clearly, I did mention about flows coming in through asset allocation products or hybrid. And I think that is a little bit more structural, where there is an element of equity and the taxation is a little bit more favorable. So possibly if this part of tax treatment for pure debt fund is not addressed, I think the hybrid and the allocator products are the way to go for investors to have debt exposure based upon their, I think preference in terms of how much of exposure you would want to have in debt.
Right. Mr. Thakkar, you said there is a case to look at overseas, assets. Given that we are constrained in terms of how much we can invest in overseas markets, is gold and silver, which are essentially dollar-denominated asset classes, does it make sense to look at them, or they can't substitute, like, say, investing in the US market or something?
So overseas route is available. It's just that mutual funds don't have the leeway to invest overseas. Individually, every financial year can take out 250,000 US dollars. And I think more than 50% of the asset management companies have already set up entities in Gift City, and more are on the way. BFSI event itself had a Gift City session earlier. So I think people should actively look at that. Gold and silver largely have gone up based on central bank buying. So typically after such a sharp run up, I would be generally cautious, but otherwise these are assets with no inherent cash flow. So very difficult to form a view on what is the outlook.
True, yeah.
Basically is a guess on what two individuals will trade at 5 years from now. So that's Absolutely. Inherently unpredictable. I would still recommend people use the LRS route to have some global diversification. outside of the domestic mutual fund products and maybe through the gift city domiciled entities.
There is one very popular view that the kind of money that is coming into mutual fund schemes is giving a flow to the market, or it's not allowing the market to come down to reasonable levels. Do you believe in that theory that, the domestic liquidity is cushioning the market from falling?
If that was the case, markets wouldn't have corrected in Jan, Feb, March, right? So I don't think, this is a narrative in the mind. I am investing because somebody is putting, because SIP money is coming in. People are saying markets wouldn't come down and others are investing. So it's more a narrative driven by that. I have seen a lot of people just wanting to know if the SIP money is going up or down on a monthly basis to be able to take decisions of their investing. So it's all a narrative which is there. If you have bad earnings, a seller will come from anywhere. Right? A seller has come from foreign investors selling so much when we thought, where will foreigners go? This is the only market to be there, right? So they've gone away and they've actually sold. You've got promoters selling. So markets have their own way of balancing. Only flows matter for 6 months, 7 months, 9 months, or maybe it's there. But beyond that, I think it is fundamental flaws. And yes, they keep it a little elevated, but I think they cannot determine what returns investors will get over a period of time.
I have one last question, then we can go to the audience. I think identifying themes or sectors also is a key to making good returns. So are there any sectors that look attractive at this juncture? Anybody can take this question. Mr. Patil, would you like to take that? I mean, any particular sector that attracts you?
Yeah, so I think, compared to what we had seen around 2-3 years back, we saw big tailwinds which were there, right, for sectors like, for example, the real estate sector, or prior to that, we saw in the investment-led sectors, right? There was a big tailwind, PSUs. I think we're not seeing any big tailwind, but clearly I think the one framework which one would look at is the sectors which have underperformed, right, or which have been the laggards, right, of the last 2-3 years, to look at if there are any drivers over there, okay, which can do well. So from that construct, if we look at obviously there is some of these consumption-oriented sectors. Auto is one sector, okay, which has received some kind of a boost last year. Okay, was not such a great year. But other discretionary sectors, consumer durables, again, had a pretty bad year. Urban consumption was weak. So with the rate cuts, okay, with the stimulus which has been given and the pay commission, okay, which would be there, right, 8th pay commission next year, I think there could be a more sustained recovery in some of these sectors. So clearly, discretionary consumption is one sector which I think one can look at. Obviously, from a structural long-term perspective, also there are enough drivers over there, like per capita income going up. And another sector which, again, from a contrarian point of view, one can look at is that IT sector. Again, no immediate drivers over there. But if you look at the slowdown what we saw last year, with the AI now coming in, I think the implementation of AI will drive probably the services companies also will require to do that. And I think now with US also with rate cuts coming in, I think some discretionary consumption could come back over there. Valuations are reasonable, dividend yields are very good in the IT sector, right? And again, we are not looking at any very strong growth, right? Again, broader market itself, economy itself, it's not like the earnings growth is going to again go back to around the high teens, it will be probably in the low teens. So as a contrarian, as a defensive, I think IT sector can look well. Again, when you look at from the relative performance, again, vis-a-vis IT sector, vis-a-vis the broader market, I think it shows that it is at a level which is looks to have kind of bottomed out. So that again can be a contrarian sector to look at. Apart from that, again, chemicals, again, a sector which was in a boom earlier, went through a bad phase for the last 2 years. We saw supply coming in from China. Again, there are signs, a lot of capacity addition which has happened in the last 2 years. I think it is now coming in where you could see that now flowing through and coming. So again, that can be a sector again to look at, where you could see things improving.
Thank you. So IT, chemicals, auto. Mr. Thakkar, do you have any view on the banking sector? Because that accounts to almost third of the market. So that's the biggest sector. So any views on the banking space?
Near term, there could be some small challenges in terms of the timing issue where the loans will reprice faster than the deposits. But otherwise, I think things are broadly fine. The asset quality is under control. Growth has been something of a challenge, but I think it will come back. If the overall car sales go up, there's no reason why auto loans will not go up. If home sales pick up, there's no reason why mortgage lending will not pick up. Or if corporate capex has to pick up below the AAA rated names, those people will come to the banks for debt financing. I think the sector hasn't participated in the big run-up and it's been a laggard. I think there are some good investment opportunities out there.
Thank you. We had a very stimulating discussion. I would now like the audience to ask some questions. Yeah.
Hi, good evening. Could you comment on a couple of asset classes? One is REITs and the other is InvITs. So InvITs, if we look at either road or transmission lines, does the fund manager within the purview consider these?
REITs is something we have been investing and we have a large exposure to REITs, but they've done very well. So now we are trying to see how well will they do from here in terms of returns. You know, when a few years back REITs were really cheap relative to what we thought, but if you look at the kind of returns REITs have given, they've actually delivered extremely good returns. In InvITs, frankly, you have to go stock, you have to go specific, and I would say as individual investors, these are complex instruments to actually research. And even for us as institutional investors, I would say that these are the ones which take quite some time to actually do, because in each case we have to understand how is they getting the income, how sure are the incomes, how long the incomes are, and in some cases you'll have to remember the incomes that you're getting are actually capital return, and people didn't realize it and they lost money. So frankly, I would advise that when people are investing in InvITs, they have to think very carefully about this, whether they're getting their capital back or they're getting their interest or dividend back. So I would say that easy return phase is over, where, you know, people saw these instruments as very easy ways to make money. And I would say one has to be more careful. But if I take a 10-year view, I think these instruments will be very good. And at some point of time, I think maybe the industry will have so many InvITs and REITs that a separate InvIT REIT fund will come up. That's what I'm thinking. And these are instruments where actually a lot of work is required at the level of a mutual fund to look into it deeply. And that is what I think.
Yeah, I think it's a new asset class which is shaping up quite well. There's one gentleman there.
Yeah, thank you. This is Sachin Seth from Criff Highmark. Just quick question. We have seen in the last 5 to 6 years, a lot of companies coming with offer of sale, which are basically typically private equity funded or buyouts of private equity, right? Even today also, Lenskart is there, right? But we also have a similar industry companies coming, which are typically bootstrapped or built by promoters themselves over a longer period of time. So as a fund managers, when you evaluate, do you give any kind of a premium to companies coming with private equity governance, etc.? Because when we, as an investor, look at market, we generally tend to see that these companies come as a stretched sort of probably investment or the price. So just comment on that, and how do you look at it when the same type of company comes from two streams? Thank you.
So, okay, let me take that. So I think, I mean, there are clearly, I think, a promoter-led company coming to the market, okay, who has a long-term commitment in that. And this thing is something which normally one would give if the promoter is good, and if we believe in the vision of the promoter, then probably we'll be more comfortable. See, private equity is normally when they come in, they try to max out because they have invested and the idea is looking at an exit. And most of these companies which are coming in, they don't have a promoter as such, right? In promoter, any initial promoter, the holding will be very, very minuscule. And there are a lot of supply, okay, which is likely to come in because initially you will see some exits, but there will be more exits coming in down the line. So that is something which we normally need to factor in. And then what happens, right? When most of the private equity investors are out, then whether that company has got a proper governance or a board really to really take it forward from there. So all these factors, I think we need to look into it when we are evaluating these companies. The good thing is that a lot of the company with private equity, they have already have a certain governance structure in place, and that has been in place. But clearly, I think the supply and the commitment of the private equity, how long their tenure is, right? Okay, is something which all these factors are factors which we look at when we decide in terms of what kind of a premium one needs to pay over there.
I have one follow-up thing. So, I mean, there are these private equity companies where have to be an exits after 3 years, 4 years. So that creates some supply overhang. Is that something that sort of impacts pricing, and that's something that plays out on your mind when it comes to looking at such companies, or?
No, actually, one of the things we worry about after the last supply is now there's no owner. And then we think, like, how do we handle a company where there's no owner?
Yeah.
The CEO without a stake also becomes the owner.
Right.
See, we're grappling with all kinds of issues, and we don't know how much the PE has actually, as Mahesh also pointed out, how much he has underinvested and created higher earnings in the near term. A lot of challenges we are facing.
Right.
I mean, actually, if you ask me, and these are the ones where the maximum number of blocks come these days.
Correct.
So we're having a lot of challenges, and you have to remember we are handling other people's money when we are investing. So frankly, all these PE companies, all these new age IPOs, they are all forcing us after many years to actually rethink many things, and every day we worry, are we doing the right thing? And and it's worrying.
Absolutely.
Do we have all the answers? No. If we sometimes stay out and then find that the stock is going up, we would have error of omission.
Right.
By investing and then losing money, we will have error of commission. Do we have to worry about error of omission or error of commission? That is the debate we have internally in our company. I would say we are not going through an easy phase today.
Absolutely. What you said is right, because a lot of times you see like a large block, and after which stock sort of runs away. So it becomes difficult to understand why.
This point, which is very there, the difference in character of markets has changed, like you're saying. So previously, a promoter company, the promoter would have 75, 50, 60% stake, right? Today, an IPO is just say 10% of the company. But after that, you have got 75% of the float available immediately.
Okay.
And it does play a overhang because at least for a period of time, it does have a, I would say, pressure on the stock. And so it's very different from a promoter-led company where he intends to hopefully stay for a period of time and have more than 51% and all that. Second is this is happening more or less for the first time or, in the early stages. I think institutionalization truly on a corporate boards is just starting to happen. I mean, so it will take 5-10 years for us to really get a sense on whether it really works or not.
Interesting. One last question, please.
Hello, I'm Harish Vora. I got
Sir, speak into the mic.
About arbitrage funds.
Sir, speak into the mic. We are not able to hear.
Hello. I'm Harish Vora. I just want to add, suppose a fund is for... Okay. Suppose a fund is for 3 months, I want to park it, then arbitrage fund is a better or money plus is better, number one. And secondly, arbitrage fund anytime give a negative return, what are the negative side in arbitrage fund? Second question, suppose long duration fund is a better or this gilt fund is better? Third question, recent amendment about recent introduction of...
Sir, I think 2 questions should be enough.
No, arbitrage funds on 3-month basis have never given negative returns to our knowledge. Even on 1-month basis, they have never given, so that's fine. So arbitrage is a good product to invest in if you're in the high tax bracket and to want to invest for 3 months. I mean, in our framework, long duration and gilt funds are, long duration funds are, if you believe yields will go down, it's a good idea. And gilt funds are also a good idea if you believe yields will go down. Both are similar in our framework. I don't know, Rajeev, you can add.
You can take the second question, yeah.
No, I agree with what you have said.
Thank you. One last question.
Hello, panel, and thank you for your time. As many experts advise retail investors to us, that mutual fund is the best way to go ahead. But today, if you see, there are many schemes are running. Many experts are suggesting us to have a diversified portfolio. So why we are running so much schemes if the experts are saying that we should have a diversified portfolio? And the second question, why there is a each month NFOs are coming and making more confusion to us as a retail investor?
The second question I want to answer. See, basically the first let someone answer. See, we manage 6 lakh crores. I don't think we want to manage 6 lakh 20,000 crores in hybrid and equity in one scheme. Frankly, just imagine if you had one scheme with 6 lakh 20,000 crores. I don't think it's good. I think having a large number of schemes is useful for us. You, at your level, having having a certain amount of money, it's useful to have a few schemes. But for us, it's useful. On the first question, I leave it to others. Diversification.
Yeah, I know. So I think you have addressed that question to a large extent. I think. See, again, as a manufacturer, our job is to give a different product, on the risk appetite, right? And see, I think to simplify that, I think there is a beautiful way of trying to do that from an investor perspective, right? To go with the complication of which fund to select. The fund of fund route, I think is now a vehicle, I think, which can become more popular, or because now the taxation issue, which was there earlier, impediment, that has been taken away. So that becomes a good vehicle for an investor perspective to invest only in one fund and let the asset manager or the fund house decide, how you allocate that. Like, for example, we have this thematic fund of funds, right? So you can decide in which sectoral thematic fund to invest into depending on which theme is likely to do well based on internal processes. So I think that is, a solution going forward where the plethora of schemes which are there from investor perspective to solve the problem, and the fund of fund will be a great route, to really solve that problem.